It looks like this is a very cheap stock if you're using GAAP net income, which for a lot of proclaimed value investors is the end-all be-all of profitability. There's a tremendous amount of value in digging below the surface because just flat out, all-out sales growth should not be the end-all be-all of making a stock purchase decision.
Welcome back, all. Today, we are going to be focusing on some small cap favorites, including one we've started buying again. So if you've been here a while, you may know who that is, Aehr Test Systems. We are going to correct some statements that we made on Aehr Test Systems in a past video, and then we'll jump into two other companies, INDI Semiconductor and ACM Research. Let's get started by playing you a clip from a recent Aehr Test Systems video.
There are a lot of automakers choosing to, in Erikson's words, roll the dice with their silicon carbide devices. They're using other methods to weed out bad silicon carbide chips other than burning them in. I think there's a good example of this, Kasey, that illustrates this point, right?
STMicro has been supplying Tesla chips since 2017, but they're still a very small customer of Aehr. And we're talking about Tesla, one of the biggest EV makers. So obviously, they're not testing with burn-in on all of their silicon carbide chips.
So in this video, we need to make a correction. We made these statements after a recent shareholder earnings call, but we had a commenter correct us on this, and I'll let Nick get us up to speed on that recent comment.
So the commenter is Gayn Erikson, CEO of Aehr Test Systems. We cannot confirm if this is the Gayn Erikson, CEO of Aehr Test Systems or not. But at any rate, we can confirm that the correction is in fact true. So here's the correction. The commenter said this: I'd add that it is well known in the industry that Tesla does in fact purchase 100% of the silicon carbide devices for their EVs with an extended burn-in. Kasey, we've done quite a few updates on Aehr Test Systems over the last year and a half, and we do have this in our notes, but I think it just fell through the cracks. If you'll recall, back in early March 2023, Tesla had an event talking about the lowered need for silicon carbide chips for its next-gen car. The next day, Aehr Test Systems had an extended clarification on what Tesla was talking about and the future roadmap of silicon carbide chip development. And near the end of that press release, there was this statement: we, Aehr Test Systems, believe the business use case for our solution actually increases. Wafer level test and burn-in of 100% of die and extended burn-in times will be required to earn Tesla's business. Those comments we made about some confusion regarding how much of Tesla's silicon carbide chips are actually being tested and fully burnt in, that was a mistake. Most of the questions going forward are not surrounding Tesla, but all specifically the electric vehicle automakers out there. So Aehr Test Systems demand still very much alive and well. We'll be providing an update after the company's next earnings report, probably in January 2024 is when we can expect that to come out. In previous videos, we had talked about some potential softness in demand coming up because of Aehr's primary customer on semiconductor. Again, we'll talk about that here shortly, hopefully within the next month or so.
Let's play you, just for fun, one more clip from that video and a correction that needs to be made from our commenter.
CEO Gayn Erikson mentioned that he would never drive a vehicle that did not get their chips tested with burn-in equipment. I don't know who that is. I have no idea. He didn't mention what kind of car he drives.
Okay. So now this is where we really cannot confirm with 100% certainty if this fact is true. But again, our commenter, Gayn Erikson, said, for the record, I drive a Tesla with silicon carbide inverters on both the front and rear engine. And yes, the silicon carbide devices in those inverters were burned in to ensure the reliability needed to last the life of the car without failure. Okay, if this is the Gayn Erikson, we now know he drives a Tesla, Kasey.
That's an excellent choice, sir. Thank you very much for commenting. We appreciate the correction made, and we hope this clears any muddy waters that we made regarding Aehr Test Systems and Tesla. If you do not know what test and burn-in is, we'll make sure that you have a link here in the video and in the description for a video that we did about that, addressing that process. And in case you missed it, we did start purchasing Aehr Test Systems stock again here just a couple months ago. So as Nick mentioned, we will have an update soon on their earnings release. So stay tuned for that. Let's talk about INDI Semiconductor.
Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this.
INDI Semiconductor has made a lot of waves in especially electric vehicle and advanced driver assist systems inside those electric vehicles. But the question is, will this company be able to continue their rapid growth, or are there going to be some roadblocks ahead?
Maybe just a quick refresher for everyone out there on our personal process with a small cap stock like this. So we did purchase a little bit of INDI stock at one point in the past. We actually made a little bit of money on it, but typically what we do is when there's a potentially promising small cap stock, we'll take a very, very tiny position and we'll build it out over time and buy in small batches. And if the story continues to make sense to us, we add to the position along the way. It'll eventually build out to a full-blown position in our portfolio. But this is one where the more we learned about INDI and the more we dug into the SEC filings, annual reports, the quarterly filings, the more we learned, the more questions we had about the business model. So we sold earlier in 2023. Again, if you missed those past videos, you can find them in our description below. But let's maybe take a moment and get up to speed. Kasey, there's three primary issues we have with ownership of INDI Semiconductor stock at this point, because the growth story is undeniably very good. Companies still putting up just over 100% year-over-year revenue growth. But there's a tremendous amount of value in digging below the surface, because just flat out, all out sales growth should not be the end all be all of making a stock purchase decision. That's just too easy. That's too easy. What are the issues?
Let's first talk about share dilution. Revenue has soared in the last couple of years. Revenue has more than doubled from the year prior in 2023, up 101% to $60.5 million in Q3 of 2023. The stock price remains down around 15% from INDI's 2021 IPO. That's one of the reasons we need to talk about this share dilution. While the revenue is soaring, it's partly inflated by acquisitions funded with new shares. And so this means your slice of the pie is getting smaller as a shareholder.
Right. And just to put this in hard numbers for you, basically what we're doing was we're not just measuring absolute revenue growth, but revenue growth on a per share basis. Because many of those acquisitions INDI has made over the last few years, especially over the last year, you can see multiple sizable acquisitions, especially in the last year. They're paying for those purchases in the issuance of new stock. So unless you were buying more stock to offset this dilution, like you said, Kasey, your slice of the pie is getting smaller. And so what this means in actual per share terms, you take the last reported trailing 12-month period, total revenue is up 92%, pretty darn good. But on a per share basis, revenue growth is up only 72%. That's big dilution. Now, 72% is still fantastic growth, but I think you get the picture. That's a big dilution of your ownership of what seems to be stellar revenue growth. And the company's not finished with that dilution either.
Point number 2, complex shareholder structure. INDI's SPAC origins and reliance on Chinese investors, some with potential IPO rights in the future, add a layer of confusion and potential dilution down the line.
Let's maybe address this in 2 sub-points. The first sub-point you can find in the Q3 2023 quarterly filing with the SEC. You probably heard INDI management talk about this on the earnings call as removing a risk going forward. And to a certain extent, yes, we believe this is true. Kasey, you mentioned INDI's SPAC origins. So the company went public in 2021 via a special purpose acquisition company. We won't go into the ins and outs of how that works, but essentially there are still these warrant obligations that were still outstanding on the company's balance sheet as of the end of the third quarter of 2023. Those were worth 52 million in outstanding warrants. Subsequent to the end of the last quarter, at the end of September, the management went out and settled those obligations. They repurchased the warrants, settled them in issuance of new stock. When you see the Q4 earnings report, there's going to be this massive share count increase. So at the end of Q3, total shares outstanding were about 147 million. And in Q4 2023, when INDI reports, probably January, early February of 2024, that's going to go up to 181 million, basically 23% quarter over quarter increase in total number of shares outstanding. Now, those warrants are now gone. They're settled. So it does remove that overhang, as management called it, of risk for shareholders. But do bear that in mind. You're going to have a lot more dilution in your revenue on a per share basis.
And I'll just restate that second point about the potential for another dilution event with Chinese investors. INDI operates through a majority controlled but partially owned subsidiary in China called Wuxi INDI Microelectronics. And so some of these Chinese investors, including a couple of automotive equipment manufacturers, retain those equity investments in Wuxi.
Now, I'll explain why this is a potential issue. So in Q3 2023, 46% of INDI's revenue came from China. And so that only partially owned subsidiary, that's what houses nearly half of INDI's revenue, Wuxi INDI Microelectronics. And so there are several Chinese investors, including a couple of large Chinese OEMs for the auto industry, have that equity investment in Wuxi. Wuxi's pursuing that IPO in China by 2027. But if it isn't successful, those Chinese investors will be payable in more INDI stock, which is, of course, listed on the NASDAQ in the US. So let's just simplify this and say there is probably still a lot more shareholder dilution coming down the pike for INDI Semiconductor shareholders. That's the problem with the company's very, very aggressive expansion strategy via merger and acquisition. It's had to issue a lot of new stock and a lot of future stock payable down the road to help pay for these things. So it's not just a flat out growth story. This really obscures what the business's actual operational strengths are on a standalone basis. Lots of questions here.
One other point we want to talk about with INDI Semiconductor is their profitability. Currently on the balance sheet, they have 161 million in cash and short-term investments, but also total debt of 161 million. And the company isn't profitable yet. Operating income and free cash flow are both negative. They're still burning through a lot of money.
Yeah, and management has been talking up the fact that they're going to reach adjusted profit break even in Q4 2023. But these are on an adjusted basis, and some of these metrics back out interest expense. It doesn't include things like tax. It's complicated. Let's just leave it at that. This company is still a long ways away from turning a profit by all profitability metrics. Management will be relying on adjusted profitability metrics pretty heavily to make this case, to make this story. Not a clean balance sheet anymore. Equal parts cash and debt as of the end of Q3. Again, in addition to lots of shareholder dilution, INDI also relied on a lot of debt, especially in the last year, to fund its expansion. For us, Kasey, I think the ultimate story is there are too many questions left unanswered for us to feel comfortable investing in this company. Does that mean we'll be wrong and the stock skyrockets in 2024? Absolutely could be. But for us, the risks to only potential reward just don't really quite work out, at least for us.
Let's talk about ACM Research. ACM Research's shares have skyrocketed up over 100% this year, and that's fueled primarily by China's very ambitious chip making plans. We'll talk a little bit more about why this company is so reliant on China and why this may be an interesting bet on the future of chip making in China. China is attempting to produce the chips needed, especially for their fast-growing EV industry, as well as for general domestic consumption. Most, but not all of these chips are known as mature node manufacturing chips. This means that these chips are not made using the most leading edge manufacturing techniques. These would be chips such as NVIDIA's AI chips, maybe Apple's most advanced chips that are going into their equipment. Rather, these mature chips are used in well-established tech and industries. And ACM Research is helping fill the factories to make it happen. ACM Research especially sells equipment for cleaning and prepping the silicon wafers, the foundation of every chip. With China's chip makers on a buying spree, ACM's revenue has soared and their profits have doubled.
We have a nice slide here that ACM Research continues to provide in its quarterly presentations. Most of the revenue is tied, again, like you said, Kasey, to the cleaning and prep equipment for those silicon wafers. The discs, people in bunny suits holding, it starts as a silicon ingot. They get diced into these really thin discs. And there are dozens of steps in the manufacturing process that manipulate and change the surfaces of these discs. But between each of those many dozens of steps, there's a cleaning and preparation phase. And again, most of ACM Research's equipment is designed for that, providing a very thorough but gentle cleaning and prep process. They do have some other equipment that they're expanding into as well. You can see below the cleaning section where most of the revenue comes from, there's track. So track equipment, often used in tandem with photolithography equipment, like from, of course, ASML Holding. And these pieces of track equipment basically help with the flow of photolithography, because photolithography is not done in just one single exposure step. There's often a multi-patterning, multi-exposure going on the surface of those silicon wafers. Also, PECVD. PECVD stands for Plasma Enhanced Chemical Vapor Deposition. So deposition is the laying down of some sort of chemical that actually reacts with the photolithography. That's a very delicate process. And so plasma enhanced CVD is a type of lower energy, lower temperature CVD step that helps lower things like energy consumption. And then, of course, advanced packaging, including chiplets. Lots of talk about that in the industry right now. Oftentimes, advanced packaging, not necessarily for leading edge chips. Oftentimes, these are maybe just mature chips, but getting packaged up in some sort of more advanced way. So ACM trying to get more into this market as well. But let's take a look at the overall revenue here, because again, most of this is the cleaning and prep equipment, and most of it is going to China.
In the first 9 months of 2023, the total revenue for ACM Research is $387 million, and nearly $376 million of that came from its customers in China. Nick, I know this company also has a bit of a complex structure. Can you tell us a little bit more about how that looks to us as investors?
Yeah, you'll notice some similarities here to INDI Semiconductor, or at least the path that INDI Semiconductor is on in the future. ACM Research has already undergone some of these steps. But so you just rattled off that figure, Kasey, nearly all revenue, well over 90%, approaching 100% of revenue this year from China. And so you might be wondering, how in the world does ACM Research, a company based in Silicon Valley, California, sell all of that equipment to China? Surely that is a massive risk, both from regulators in China as well as regulators here in the US. And if you do some digging in the company's annual reports, you'll find that segment actually operates as a not wholly owned, but majority owned subsidiary of ACM Research. That subsidiary is called ACM Shanghai. And ACM Shanghai actually had an IPO in 2021. And the purpose of that was to help reduce some of the complexity of a California-based company doing most of its sales to China. That's how they were able to skirt some of this, is operating through that majority-owned subsidiary. ACM Research, the holding company, traded in the US, owns over 82% of ACM Shanghai. And so there are some minority shareholders in China for the subsidiary business operating in China that handles most of the revenue for this company. We actually have a picture of the company's shareholder structure and business structure here provided in the last 10K earlier in 2023. And you can see how most of the business flows through that left side of the chart, through the China subsidiary. There are some other subsidiary businesses as well, but nearly 100% of the revenue currently flowing through the Chinese subsidiary.
ACM Research has made some changes, and it's attempting to expand the relationships it has with chip makers in the US and Europe to expand and diversify that revenue base. So this is a very complicated business structure at this point, but it's possible that they are able to diversify a little bit more. But if you're a US-based investor, there's definitely some geopolitical risks there. So far, ACM Research has done a very good job at making some exceptional growth here with its primarily Chinese fab customers. Let's talk about its profitability going forward and whether or not this stock is something we would be interested to add to our portfolio.
For sure. Let's talk about profitability. We addressed this on the first and the last update we did on ACM Research a couple months ago. It looks like this is a very cheap stock if you're using GAAP net income, which for a lot of proclaimed value investors is the end-all be-all of profitability. But that's actually quite complicated, because if you look at this, as we record this, ACM Research stock trades for about 16, 17 times trailing 12-month GAAP earnings per share. That looks cheap for a company that's expecting to grow 30% to 40% as we close out calendar year 2023. And it is if you're using GAAP net income. But remember, one of the downfalls of GAAP net income, it does not include upfront cash expenditures on property and equipment. Past spending on property and equipment is depreciated, and past spending on intangible assets, think patents, is amortized over time, not accounting for lump sum payments taking place right now. So this company looks very profitable, but if you look at free cash flow, you can see this large discrepancy. Typically, we talk about companies that are operating at a loss, a GAAP net loss, but generating lots of free cash flow. This one's actually flipped the other way. GAAP net profitable, but negative free cash flow. This is one of the downfalls of a fast growing company that makes equipment, and it's highly tied to the manufacturing industry. They're spending a ton of money right now on new equipment. They're expanding into new markets like South Korea. And so their CapEx, their capital expenditures, are elevated. Those are going to be depreciated and amortized over time, but you have to take into account the cash outflow up front. And that's why free cash flow is important. The company operating deep in the red at the moment. So that seemingly cheap stock price, not actually as cheap as it may look. I know this is weird and confusing. This is nerdy accounting stuff, but that's the main takeaway. GAAP net profitable, but deep in the red on a free cash flow basis. You can't simply say that the stock is cheap because of the PE ratio being just 16 to 17x over the last trailing 12-month reports.
We already mentioned that this was a record year for chip manufacturing equipment in China for ACM Research, and there is a possible slowdown at the beginning of 2024. We don't know yet for sure, but management did decrease their outlook for full year 2023 revenue guidance from the high end of 585 million down to 520 to 540 million. That would still imply a 2023 revenue growth as high as 39%. This is still very good, but we're not sure if this will continue into the first half of 2024. We discussed this with other chip fab manufacturing equipment companies like ASML and Applied Materials, it's possible that there is this slowdown going into the new year. What are we doing with ACM Research? Is this a buy, watch?
I think we're still sufficiently interested to continue watching this stock, but I think we want to see what the initial guidance for 2024 is first. This is a bit of a binary outcome. We could wait and see what the initial guide is and the stock shoots higher, say la vie, or maybe guidance isn't all that great and the stock tanks. We're just going to wait and see though, and we can live with it. So I guess maybe to round out this little small cap roundup, Kasey, to reiterate, we started buying Aehr Test Systems stock again within the last couple of months. INDI Semiconductor still does not meet our criteria to be included in our small cap stock basket, which typically is composed of about 24 or so small cap stocks. ACM Research might meet those criteria, but we're happy to continue watching to see how this thing plays out.
There you have it. Let's wrap this up for this episode of Chip Stock Investor. Later this week, we will have our top chip stock picks for 2024. So stay tuned for that episode. Make sure you hit the subscribe button if you haven't already, and make sure those notifications are turned on. See you all again very soon.